all for joining us for part 3, the finale of our 3-part series to our Plan 365 Financial Literacy Month virtual series in partnership with Charles Schwab. So I know that some of you have been able to join us for our first 2 sessions. Some may have been able to join 1 session, and then some of you, this may be your first. For those of you that missed either of the first 2 sessions, please feel welcome to go to our YouTube page. Both of those sessions are now live, so you can go back and review those. I'm Kimberly Saunders, the president of the Central Florida chapter of the National Black MBA Association. And for those of you that may be unfamiliar with the National Black MBA Association, we are an organization committed to leading in the creation of educational, wealth building, and growth opportunities for those historically underrepresented as careers, professionals, students, entrepreneurs, and professionals. We have over 40 chapters nationwide. The local chapter covers roughly 5 counties, over 175 members, roughly 25 programs throughout the year. This is our current Central Florida Chapter Executive Board. So again, on behalf of the chapter board as well as membership, we just thank you for joining us this evening. And for those that also have gotten a chance to view the first 2 sessions, we hope that you gained a plethora of information that you can take with you in building your financial futures. So again, this is our last part in our 3-part series, and we will be welcoming back Hayden Adams, as well as we will have Leroy Jean-Pierre, who is an estate planning attorney. So I will have them introduce themselves very, very soon in the program. But we will be covering retirement and income planning this evening, as well as estate planning. And again, as you can see in the chat box, if you have any questions, please feel welcome to type those in the chat box, or you can always raise your hand, and then that way we can allow you to ask your question live. So that way there'll be dialogue with the panelists this evening as well. Before we get started, I'm going to show a short video on Charles Schwab, for those of you that may be unfamiliar with the organization. Just a little bit of background: they offer investors a contemporary, full-service approach to manage their investments, providing investment-related products, services, and sophisticated financial planning that combine the best of what people and technology have to offer. They are a multinational financial services company offering banking, commercial banking, a trading platform, and wealth management and advisory services. So that is Charles Schwab. All right, so we are ready to get started. I am going to have our panelists for the evening introduce themselves. And we're going to start with Hayden Adams, and then we can go to Leroy. If you all can just tell a little bit about your backgrounds and whatever else you would like for us to know, and then we'll get started in question and answer portion.
Hi everyone, I'm Hayden Adams. I'm a certified public accountant, a certified financial planner. I'm the director of tax and financial planning at the Schwab Center for Financial Research. So it's kind of an independent group within Schwab. We're kind of product agnostic. We just provide advice and guidance. And we don't actually care if you use Schwab products or somebody else's products. In the end, it's like the advice we give. We just want to make people have a better future. And so we write articles, my team, the group that I work with, and post them on Schwab.com. So if you go to Schwab.com and look at insights, it's like right at the middle of the top bar, you'll see a bunch of topics in there: tax, retirement planning, all that kind of stuff. Myself and others write articles and place them there. A little bit about my background. I'm actually originally from Central Florida. I grew up in a little town called Eustis, and I went to the University of Central Florida, where I got my degrees in finance and accounting, and ended up moving out here in Colorado and became an IRS agent for 8 years, and then been at Schwab for the last 5.
Thank you so much, Hayden. Leroy.
Hi, yes, good evening, everyone. Just want to say thank you to the National Black MBA for inviting me. My name is Laura Jean-Pierre. I am an estate planning attorney. My background is mostly in finance, and actually at Charles Schwab as well. I worked before as a personal banker, and from there, working at Charles Schwab as an advisor specialist for about 3 years or so, and most recently Merrill Lynch as a financial advisor. So my background is mostly in finance, and I think it's through finance that I discovered that there was a gap in estate planning, and one of the main reasons I decided to go to law school and practice estate planning. So today I'm just here to answer your questions, because estate planning starts with a conversation. So I'm here today to answer the many misconceptions that we have around estate planning and help you guys with whatever you guys may need.
Awesome, thank you so much. So as you see, we have 2 awesome panelists. All the panelists have been absolutely great for the last 3 weeks. We have 2 amazing panelists with a lot of background, a lot of information to share with you all. So again, please, if you have any questions, do let us know. Raise your hand, type it in the chat box, and we will make sure to get to it this evening. So we have an hour planned. We want to make sure that we cover as much information as possible. So we're going to start with, since tonight we're going to be doing the retirement planning and income planning, as well as estate planning components. We do realize that there may be some discussions as we talk about previous topics as well. We talked about tax planning, investment planning, cash flow management, insurance planning. So we know that some of those may tie in to some of the discussions this evening. So just to start off, I'm going to start with retirement income planning. So Hayden, I know that this is probably a goal that's on everybody's list, right? When we talk about what are our financial goals, and retirement is probably top 2 for most of us. I want to retire regardless, when that is, but that is a big accomplishment, I would say, for probably the majority of us. So can you tell us a little bit about what should we start to think about when we consider retirement planning? What age should we start to think about planning for retirement? And really, how does that look different for us than it was for our grandparents or even for older generations?
Yeah, that's a great question, because it is going to be a little bit different. I mean, we are in a very low interest rate environment. So when you think about when you're going to retire, where are you going to generate that income? Because in the past, maybe your grandparents, they might have been able to get 4 or 5, 6% interest rates. And so they could have had CDs, or they could have had bonds and generated enough income during their retirement to provide for all their needs. But with such a low interest rate environment, that's really not the case for most people. The amount of money you need to have to generate enough income to live off of the interest alone would be astonishing. It's almost like not many people will ever save that much money. And so when we think about retirement, one of the keys is to think about it as early as possible. Like you can't think too early. I mean, honestly, like if you can start saving for your own kids' retirement right now, and maybe get them a Roth account if they've got like a summer job or something like that, that's a great way to start things out. But again, it's never too late either. That's the other thing. A lot of people feel like, well, for example, myself, I didn't make a bunch of money early on in my career, and so I didn't really save that much early on, and I'm making up for it now, and I'm saving a very large percentage of my income. So the more you can save, the better. But when it comes to actually kind of figuring out how much do I need to save, that's actually the hard question that a lot of people face, is that like how much do I actually need to live on? Because you may think like, oh well, I make $100,000. I'll use a round number, And so I'm going to need $100,000 every year when I'm in retirement. But that's not necessarily the case. What you may end up finding that is like by the time you retire, maybe you own your own home, maybe you own your cars, maybe you don't need to spend as much. Generally, what we find when people retire is their expenses are kind of high at early retirement, because when they retire, they might want to do a lot of travel, have some fun experiences, and then expenses tend to drop into retirement after you've done all that travel and stuff like that, and people kind of settle into retirement, and then they'll go up a little at the end of retirement due to medical expenses. And the reason I'm talking about the expense side of retirement is because that's what you kind of need to know and estimate to determine how much you need to save. So when you can kind of get a rough idea of how much do I need to retire on, and it's like, it may dip for some people, maybe it'll just be linear. That's what the 4% rule is. I'm sure a lot of you have heard this rule that says, like, take 4% of whatever you've got in your retirement account and inflation adjust that every year, and that's what you can live on throughout retirement. That number actually overestimates in many cases how much money you'll need to retire on. And that's why, like, more of these modern models, and you can meet with a financial advisor who can help estimate what those retirement expenses are. At Schwab, we use a program called Money Guide Pro, which can allow you to do some modeling as to like how much you'll need to retire on. And are you saving enough to meet that goal? There's many softwares like that. There's Money Guide Pro just happens to be the one we use, but there's other ones that are really good. So one of the keys is to kind of learn about your expenses, learn about what kind of lifestyle are you planning on leading in retirement. That way it can help you better estimate how much money you'll need to actually retire on.
Awesome, thank you so much. I know that a lot of times we look at, traditionally, when we think about our grandparents, great-grandparents, and, they worked for 30, 40 years for the same employer, they had a pension, and, they're, sitting comfortably, I should say. They may not be, sitting pretty, but they may be comfortably because they have that, steady flow of income. And I know these days, it's very difficult to find corporations that still have a traditional pension plan. So what's offered as an alternative to the pension plan that some, may not be aware of, and what should we be taking advantage of at this point?
So I think the primary method that most people are saving now is through various tax-deferred retirement accounts or tax-advantaged retirement accounts. My father-in-law used to be an FBI agent. He was an FBI agent for 30 years. And so he's got this amazing retirement plan that like pays him an X percentage of his salary for the rest of his life. I think it's like 70% of his salary for the rest of his life. A great pension. But he didn't have 401k or anything like that. He didn't need it. And I actually, because I worked for the government for 8 years, I got a small pension, but it's nothing, not 70% of my, it might be like 10% of my wages for the top 3 years I worked there. So it's not a lot that I'm going to get out of that. So basically the primary method for saving these days is through those tax advantaged accounts. And I highly encourage people that once you've saved enough to have a nest egg, a little bit of an emergency fund, to try to maximize those tax deferred and tax advantage accounts as much as you possibly can. And there's a variety of them. You've got 401ks. The nice thing about them is that you can contribute a pretty large sum of money to them. So I think it's $19,500. And with those accounts, you can stash away a lot of money, plus you might get a match from your employer. But then on top of it, we've got all different varieties of IRAs. So there's some that are specifically geared towards self-employed. There's some great ones for self-employed people, because like if you own your own business, you can potentially put away up to $56,000 a year into one of those IRAs. And then we've got the traditional IRA where you can put $6,000 away per year. But then on the other side, we've got some other tax advantage accounts like a Roth 401k or a Roth IRA. And one of the big questions I always get is, which one should I save in? Which one is the best for me? There's no perfect answer to that question because there's so many things we're estimating and we're looking over such a long time span. But as a general rule, what you want to look at and say is like, okay, do I think my tax rate today, is that going to be lower or is that going to be higher than my tax rate when I retire? And that's the key to making this decision as to which accounts you should put your money in. So if you think that your tax rate today is going to be higher than where it's going to be in the future, that's probably the situation where you're going to want to use a tax deferred account, like a traditional 401k, traditional IRA, because you're getting the tax benefit today while your taxes are high. And then when you actually take the money out and get taxed on it, your taxes hopefully will be potentially lower. Now, on the other side, well, what if you think your tax rate today is actually lower than what it will be when you retire? A lot of younger people will fall into this category. Well, in that case, perhaps a Roth is better for you, because you might as well pay the taxes today, maybe at the 10 or 12% tax bracket. And then maybe when you're in retirement and you're in like the 24% tax bracket, you can pull the money out tax-free. And one strategy that I always encourage people to do is diversify among all those accounts. Now, you can organically do it by using that method I just spoke of. Like maybe when you're younger, you contribute to a Roth. In middle age, you divide it between the two. And then when you're in retirement, or close to retirement, you're probably at your peak earning potential. That's when the tax deferred can make the most sense. But then when you retire, what will happen is that potentially you could have money in a Roth, money in a tax deferred account, and money in your taxable brokerage account or bank account. And then what you can do is decide, how do I want to withdraw this money in retirement? And that's actually a pretty interesting discussion on its own, just the withdrawal process and how do you generate that income during your retirement.
Awesome. Thank you. And actually, while we're on that topic, so we pretty much talked about if you are a working professional, right? If you have an employer that provides these avenues of, to invest within employer-sponsored retirement plans. But what about those that do not remain employed, right? We become our own, small business owner, entrepreneur, right? A lot of times these days, we're not working for decades. We're the leap of faith, and we're going out and branching out on our own. So for those of us that are business owners or entrepreneurs, what options do we have where we can still save for retirement just as if we were employed and had that opportunity that employers offer?
There's some great opportunities for the self-employed. In fact, I think that the opportunities for those who are self-employed are better than the opportunities for those of us who get W-2s and just work for a corporation. When it comes to self-employed, there's two major varieties. There's defined contribution and defined benefits plans. Now, the traditional like 401k and all those IRAs and all that, I'd call those into the category defined contribution plans. The defined benefits plan, there's some really interesting opportunities there to defer taxes. So like, say you're a business owner, I'll just make up a business up. Say you're a doctor, you own your own medical firm, and let's say you make $500,000 a year. With a defined benefits plan, what you can do is they do a calculation. You have to work with an actuary to do this, so there's a little cost associated with it. But potentially what can happen is you can defer, I believe the max deferral, like if you were in your 50s and maybe hadn't saved that much, you can defer like up to $350,000 a year into that account, because what they do is they do a calculation, say, what do you want your benefit to be? How many years till you retire? And they do a calculation as to how much you need to contribute to this account in order to get the benefit you're looking for. And so, I mean, there's huge opportunities there to defer large amounts of your income into those accounts. So that's something that many people who have a very steady income should look into. So like if you own a law firm or an accounting firm, you have a very steady income. Now, for those who maybe don't have quite the steady income, where maybe it fluctuates over time, maybe that's where a defined contribution plan can make more sense. And again, you can open up an individual 401k. You've got SEP IRAs, simple IRAs. For example, the SEP IRA, you can contribute up to $56,000 a year. And it's kind of a rule. It's like up to $56,000, but no more than 25% of your income. And so there's a great opportunity there to defer even more than what you might normally be able to defer. And in fact, you can even combine some of these plans. You could have maybe a defined benefits plan and a SEP or a individual 401k. So I highly encourage anybody who owns a business, obviously like at first, maybe like some people may be like starting out a business, and that's when it can be difficult to make those contributions because you're trying to grow your business. But at that point where you kind of feel like you're a little bit more stable, that's a great opportunity to figure out like, hey, what other ways can I defer income? And there's even tax planning ideas too in there about like, employing your children and all kinds of stuff like that can potentially help reduce your income.
Great, thank you so much. I think a lot of times, for people that do step away from, their employer to try to go out on their own, the focus is, putting as much as they can into the business to get to the point where they have, where they feel they have the adequate cash flow, and then they can start thinking about retirement again. So, good to know that there are, that there's options, how much you have, your net income, regardless of how much cash flow you do have available, that you can continue the retirement planning and savings. So I'm going to ask just one more question as it relates to the retirement portion, and then we'll talk a little bit about estate planning, and then we'll take some questions. So I know that retirement and income planning usually go hand in hand. So a lot of people think about, okay, retirement, and you hit on this a little bit earlier, that it's people say, okay, I need to get to a certain number, right? Whether that's 2 million or 3 million or 5 million, we're so focused on a particular number. Can you talk a little bit about how we should also view the income planning portion, and how we need to start looking at not necessarily what that whole number is, but really what that number will result income-wise for us, and what are some things we need to consider when we think about income planning?
Yeah, when it comes to the fact that we're in such a low interest rate environment, again, it can't, like I mentioned before, it can be difficult to generate enough income simply from bonds or something like that to provide from your living expenses. And the way we kind of like looked at things nowadays is more of a holistic approach. So how can you generate income from your entire portfolio? Because a lot of people, and this scares some people, that it's like, okay, maybe you've done the calculations and you figure out, okay, I need $2 million to retire on, to have that comfortable retirement that I'm looking for, right? First of all, a lot of people actually overestimate that number because a lot of those estimates don't take into account Social Security benefits. So like there will be an offset there during a lot of your retirement. But we'll just use a nice round number of like $2 million. When you look at that number and you say, well, how much interest can I generate off the $2 million? It's like, you might be a little disappointed. But the process of actually dipping into the principal amount is something that a lot of people should consider. Because the reality is that you can actually go in there and say, okay, I'm going to start selling some of those assets because I can live on the actual amount that I've saved. Because there's no prize. I mean, if you're not passing on those assets to anybody else, maybe you're just like, my wife and I, we don't have kids. We don't have anyone to pass our assets on to. There's no prize for having $2 million when you pass away. And if you're just living off of the interest or the dividends or something like that, you're going to have all this money that you could have used, all that $2 million, to live on during the time you lived, and had more fun experiencing all the joy of travel and hanging out with family, going out to dinner and all that kind of stuff. And what I encourage people to do is to think about it more holistically. It's like, okay, maybe I will generate some income off of a percentage of my portfolio, like maybe half my portfolio will be in some form of bonds which generate interest, but the other half of my portfolio could be in stocks. And I could use a portion of those stocks, take some of the gains, sell some of the assets, use those to provide for my living expenses. And over time, what would happen is, like, your $2 million would gradually come down and down and down and down and down and down. And then hopefully by the, you have to have a little buffer in there. You don't know how long you're going to live. But if you plan out and say, like, okay, well, I'm going to plan, for example, me, like men usually, die a little bit sooner than women. It's like, maybe I only need to plan till 85 or something like that. But my wife, who's got a family with longevity in it, she needs to plan to maybe 95. And so it's like, we can use that information, plug that into a software like Money Guide Pro, and come up with projections of how much we can spend each year. And then on top of it, the other thing to consider is, you don't necessarily have to have a fixed spending rate in retirement. So, if the markets turn against you in your retirement, you don't have to use that 4% rule that says, okay, I'm going to calculate 4% of my income, I can spend that all through my retirement. It's like, you can raise and lower it. You can say, like, well, I'm going to spend 5% early on because the markets are doing good. And then maybe the markets turn against you a little bit. You might tighten the belt a little and say, like, okay, I'm not going to spend quite as much as I was planning on, just because I don't want to dip into the market. I don't want to, like, dip into the principal on some of those assets. So there's opportunities there. And one of the big ones that a lot of people fail to remember is that, like, Social Security benefits exist. And I know a lot of people are concerned, like, maybe the Social Security system won't exist. My dad was always very concerned about that, and he's living on Social Security. So it probably will exist, because if it doesn't exist, maybe America won't exist, because if that system fails, that's a pretty big failure as a country as a whole. So in all likelihood, as long as America exists, that probably will exist. And so you can plan and say like, oh, well, look, once I hit 62, or maybe I wait till full retirement of 67, or even postpone it a little longer till age 70, I'm going to have those benefits, which will actually offset some of my living expenses. And it's such a big mathematical problem. It's not a difficult mathematical problem. There's no calculus or trigonometry here, but it is such a long time frame that we're looking at that it can actually kind of be difficult to wrap your head around, like, how does this actually work? And that's where a lot of these modeling softwares can really help to like show you like, okay, here's how much you may actually need to save. You thought it was 2 million, but it was actually 1.2 million. That's a pretty big difference. And here's how much you'd be able to spend. And, if you adjust your spending based on the markets and then take into account Social Security, like you may have either, retire a little earlier, or you could maybe be able to spend more when you do retire at the specific age that you're targeting.
Awesome. Okay, thank you so much for that information. So also, I just want to remind our audience, if you have any questions on retirement planning, please, you can raise your hand, put it in the chat box. I'm going to move over to estate planning for a little bit so we can talk a little bit about that. And then we'll come back to some of the questions. I think there's 1 or 2 questions that we may have missed from last week's call, so we'll get that in there. And then any other questions that come in, go ahead and start putting them in the chat box so we can get to those. So thank you so much, Hayden, for that overview of our retirement income planning. So, L'Aurore, on to estate planning, right? So we talked about the retirement planning. We get to that phase in our life where we feel like we can, comfortably rest a little bit, right? We'll still be doing a little something, but for the most part, we want to get to the point where we don't have to work. It's more so if we really want to work. So once we get to that point, right, estate planning also becomes a big discussion. And really, it shouldn't be the discussion at that point in time in your 50s and 60s. We should be having it, at 20s, 30s, in our 40s. And so can you just talk a little about what does estate planning entail, okay? And how does it fit in a comprehensive financial planning process?
Yeah, of course. So to start off, let's get rid of the misconception that estate planning is only for the wealthy, because I think that's one of the major misconceptions out there. But estate planning, really, if we want to break it down to simple terms, just think of it as a way to have control over your personal and financial affairs. And there are different tools you could use. You could use a will, which most people are familiar with, or a trust, revocable or irrevocable, power of attorney, and living wills. But each of those documents, really, they are there for you to guide your family and to make a not so pleasant situation as smoothly as possible under the circumstances. Because someone has passed away, or someone has, is not able to act on their behalf, and you want to make it and plan properly for them to be able to make that process as smooth as possible. So when we think of, we've been talking about the past series about having a comprehensive financial planning, and part of having a comprehensive estate planning is also planning for incapacity. So a lot of people, when they think of estate planning, we only think about dying, right? Because it's kind of like a fear of death. I think that's why we always think of dying so much. But a comprehensive estate planning deals with incapacity as well. And that we could use different documents such as, the power of attorney or dual power of attorney to make sure we address that, or a trust. So each of those documents is really based on what you want to do, but we should also think of them as a living, breathing document, meaning it's not a one and done thing that we do it today and 10 years from now, we never look at it until we need it. But it's something that we should be looking at as things happen. Someone passes away or we have a newborn. It should be something that we constantly are revisiting to make sure that we are still aligned with our goals and making sure that our wishes are well put into paper. So our family, when it's time for them to pull out those documents, that there's not a question about it. And it just makes it just a little bit better. Planning, it just makes things more organized and just less stressful during such a not so pleasant time.
And that's a great point. And, people think about estate planning. A lot of times they will say, okay, well, I don't have a lot, right? Or it is for the wealthy, but they don't consider all of the other aspects of estate planning. I think I was in my late 20s when I got all my documents together. And it is a tough conversation to have when you're sitting there in front of an attorney, they're asking you if you become terminally ill, or you're unable to care for yourself, what do you want to happen? And you have to write down those decisions. So it can be a tough conversation. So one of the things that I want to discuss right now is you had mentioned wills and trusts, right? So I think those are common terms that we've all heard of before. Most of us may have one or both in place, but can you just hit on some of the main characteristics of a will and then a trust? So, and then also the differences between the two when people are trying to consider, well, what may work best for my situation?
Yeah. So a will that most people are most common with is essentially just a document that says what you want to be done with your personal affairs and your financial affairs. And it just kind of a detailed, whether it addresses if you want to be cremated or buried, it could be as simple as that, or who you want to be the guardian for your kids. And we don't think about that sometimes, that is part of an estate planning, that if you do have young kids, a will address that issue as, okay, who do I want to be the guardian if something does happen to me? So a will, to differentiate between a trust, a will only deals with when you do pass away. So it doesn't have any power until that time has come, because it does have to go through the courts and get probated. Whereas a trust is something that, a revocable trust specifically, is something that we could use while we're alive, right? So the benefit of a trust is that it avoids probate. So we don't have to go through the courts and everything like that. But think of a trust as a contract, either with yourself or with somebody else as a co-trustee, to help you handle your affairs. And the trust, what is kind of cool about it, it is not only does with things when you are alive, but also addresses when you do pass away. So a trust will depends on where you are and what you want to do with it. You can address the capacity. So you could have provisions in the trust that if you are unable to make decisioning for yourself, that you have a co-trustee or a successor trustee that steps in and help you out under that trust document. And you could have as well, when you do pass away, how do you want your assets to be distributed, or your beneficiaries? So the two are, the big difference really is that the will only is functional when you actually pass away. Whereas a revocable trust, you can use it while you're alive, and when you do pass away, for you to be able to distribute your assets accordingly. And it's really based on what you want to do and your final goals and where you are in life as far as which documents will be best. But for both of them, everyone at least should have one document that addresses incapacity and one that addresses when you do pass away, to make sure at least you have those two basic things addressed.
Awesome, thank you. And I always, when I have conversations with people about this, I always say, if you are a control freak, and exactly, where your money is going, get a trust. So at least you are passed away, you can still control, what you want to happen with your asset, or with your assets and with your estate, so to speak.
Definitely.
Much for that. So one of the other things that with the estate planning process that is so important for people to understand is really who should be involved in the estate planning process. So if you're, let's say, a single individual, or if you're married with children, but who all should be involved in that process? How long should the estate plan be reviewed? So at what points in life should you be reviewing that information or making changes if need be?
Yeah, so to answer the who should be involved, it should be anyone that will be affected by the estate plan, right? So if we think about just the example earlier, as far as using the will to set someone to be your guardianship for your kids, you need to have that conversation and be able to have everyone around that table to decide, okay, is that person willing to act as your guardian? One, are they able to do so? Because I'm sure my sister would love for me to be the guardian to her kids, but maybe I don't want that responsibility, So, and it will be bad for it to happen that after the fact that I find out that I was named a guardian. So it should be anyone that is involved in that estate planning that is going to be affected by that decision. So whether it's the beneficiaries, to make sure we kind of avoid, bickering and anything like that. And also the people that you are appointing, whether they are your agent as the power of attorney or the successor trustees, everyone should be involved so they are not surprised and they're all on the same page, and you're able to, make sure that it's nice to have your wishes on paper, but you also have to make sure that they are, enforced and at least followed, right? So you want to make sure that everyone is on the same page and they are aware of what your wishes are.
Yeah, I think those are great points as well. Some people may talk to others, family members, and say, this is what I would want to happen. But if it's not on paper,
yeah,
appropriately and legally, then sometimes, the state can come in and it's based on, the state laws of the state. So that's absolutely important. We just have to have those conversations as well. So one of the things that comes up quite often, and this can be, Leroy, you and Hayden can kind of tag team on this based on what you've noticed, is that sometimes there are misconceptions about what takes priority. So if we have, for example, life insurance or retirement accounts or bank accounts where we can designate a beneficiary on there, but then that may differ than what our will states or what that trust may state, because maybe we didn't update, bank accounts or life insurance policies that we got 10, 15, 20 years ago. So what takes priority in those situations where we may have designated a beneficiary directly on an account versus it being different from what we put in a will or a trust?
Did you want to take that one? Okay. I'll go ahead and answer that. But essentially, when you are, and that is part of estate planning, because estate planning could be as simple as making sure that your accounts do have beneficiaries listed. And when that happens, it is a contract between you and that institution. So let's say that I have a Wells Fargo account and I've decided to let my assets to my niece. That is a contract between myself and that bank institution. So that will take over the will, essentially, because I have made that decision and I have signed a contract with the bank to say, this is the person that I want to have beneficiaries. And, if something happens, let's say I don't have a contingent beneficiary, then we could talk about, does a will come in and how does that look into play? But really the priority of things, as far as, I've named in my will, the life insurance, my son, for example, but in the actual life insurance contract, I have my brother. So that contract will govern rather than the documents, the language that I have in the will.
Yeah, and I think that's something, you're bringing up a great point. And I think a lot of people don't check their beneficiaries as much as they should. So a lot of times what happens is they open up the account and they list a beneficiary, and that might be your first wife. And then you get remarried, and then you leave your first wife as a beneficiary and you pass away and she gets the money. Even though your will says it should go to your new wife, it goes to the first wife because you never changed your beneficiaries. So you can end up with some messy situations, and depending on the state you're in, there could be litigation issues and all kinds of problems like that. And so, it's something to always consider, like, who is the beneficiary of your account? And is that going to mess with your other plans that you met with an estate planning attorney, and you've got your beneficiaries all messed up? So it's something to constantly revisit and think about. And again, maybe you have a beneficiary listed as a child on your account, but do you really want that child to be the one to get your IRA account? Maybe they inherited it really young. That might be a great opportunity to consider some form of a trust where you can determine how the assets from that trust will be distributed. So having the trust as a beneficiary rather than the specific child. So there's a lot of considerations to look at when you're doing that kind of planning.
Thank you for those responses. And actually, since you hit a little bit on minors or children, can you talk a little bit about what happens if someone does designate a minor as a beneficiary to whether it's a life insurance policy or a retirement account or any account? What happens to that money if they're still minors at the time of passing?
I'll let you take that one. I think you'll you'll be able to answer that a lot better than me.
Well, most of the time, if there is a minor and you didn't properly set it where that you have a trust so that the trust could inherit the assets rather than the minor. Typically, most institutions, what they'll do, they'll have an account where there is a guardian to take over that for the minor, because really you can't open an account just in the name of the minor. So we have to have someone that is over that account until that minor is of age. And like Hayden said, that is where the trust comes in handy, because in the trust, and I love trust, but you could really use a trust for everything in your life as far as like personal and finance, because in the trust, you could have specific language to say, until this child is 25, not even 18, because can we really trust an 18-year-old with that much money sometimes? So you can specify, until my child is 25, they should not have access to that trust. And you designate a trustee to make sure that they are making sure that those things, those languages are being enforced. So a trust is a way for you to avoid that. So where it's like you don't just have a 5-year-old listed as a beneficiary, but you have the trust that has the 5-year-old as a beneficiary of the trust. So then you avoid that issue of, having to then have someone be appointed over the minor's account so that the minor's account is properly managed.
So it sounds like with designating a minor, that money will probably just sit there until they are of legal age, correct? So they wouldn't even have access to it for the most part.
For the most part, yes.
Okay, thank you. So we have a question that came in. When you leave assets to others, are there any tax planning considerations that you should make on behalf of your beneficiaries? So this may be more of a Hayden question, or tax planning.
Oh yeah, definitely. Well, I think it's for both of us actually, because I mean, when it comes to estate planning, tax is definitely a consideration. I don't think it's the primary. Again, tax, I think your desires, meeting with a qualified attorney who can guide you through that process to make sure your desires are met, is the most important thing. But tax is obviously a big consideration. For example, like what assets should you leave? Let's say you have 2 kids. Let's say one of them is a doctor and one of them is a school teacher. You may want to leave different assets to different individuals, specifically based on the fact that one of them is a doctor and has got a very high income. So if you leave your IRA account, for example, to a doctor, under the new rules, they have to distribute those assets within 10 years after your date of death, which means that doctor, like if you gave them $1 million IRA account, they're going to have a big bump in their income, and they may pay more taxes on that than if you left the IRA account to, say, the teacher. The teacher will potentially pay much lower taxes, be able to distribute it and have more money left over, because that's what we're really looking for of tax planning, is not to reduce taxes, but to increase the amount of money we have after taxes. It seems like they're the same thing, but they're actually not, and I could maybe elaborate on that a little. But like with the attorney, like maybe you want to leave them like a smaller Roth account, because it's like, oh, I mean, or the lawyer, the doctor in my example here, if you left them a Roth account, that doesn't necessarily bump up their income. They still have to distribute it over 10 years, but because they don't pay taxes, maybe the 2 accounts even out, even though one account was smaller than the other. Both of them get the assets that you wanted them to have in the end after taxes, but one person paid a lot less taxes by picking the proper account to give to them. And another consideration too is a lot of people, when they go into retirement, there's this normal concept that it's very easy, it's simple, it works, and it can work very efficiently, that you should, when you're in retirement, you should use your taxable account assets first, then you use your tax deferred assets and use them up, you use each one up, and then at the very end of retirement, if you need more money, you use your Roth assets. Well, depending on your personal financial situation, that may not be the best option, because if you use all the taxable assets first, all those brokerage account assets, well, the only thing you have now left to give to your heirs is the IRA account, which has to be distributed in 10 years, or the Roth account. So what could be a better option during your retirement is actually to use the IRA account first, because if you use up the IRA account, and maybe by the time you passed away, you're left with all those brokerage account assets, what happens at the date of death under current law is you get what's called a step up in basis. So you can give like $10 million worth of assets to your heirs, and on your date of death, the fair market value of those assets becomes the basis of those assets, which means if they took those assets and sold them the very next day, they don't have to recognize any gain at all. There is a tax aspect of planning on what assets you want to pass on, but in the end, it's like, I think the most important person to meet with in this process is an attorney to kind of like really vet out like what are you trying to accomplish, and what are those goals.
Thank you so much. Laura, would you like to add anything to that as well?
I think he didn't hit it right on the head, but I think just to add, when we're doing estate planning, it shouldn't, and I think Hayden said it shouldn't be just about avoiding tax, really. It should be making sure that you have control over how your assets are distributed and what you want to be done with it. Because sometimes maybe the choice that what you want to be done is not going to be the best tax saving, strategy, but it's something that you really want to happen with your affairs and your financial or personal affairs. So it should be a consideration, but it shouldn't be your main concern when you're doing estate planning.
Thank you. Another question. So who should make up your estate planning team? Attorneys, accountants, etc. And should they talk with each other? I think we all know the answer to that one. So if not, is it better to meet with your attorney or your accountant first? So is there an order or does it matter?
I think it's kind of more of an organic process in the sense. I mean, probably the first person you're going to be meeting with, hopefully, would be like your financial planner. And then that person will be delving into your overall plan and strategy and looking for gaps. And they might say, hey, look, I notice you don't have an attorney or you don't have an accountant. And they might refer you to somebody. In the end, for estate planning, I think it's the attorney who is the primary go-to person. So if you're meeting with your accountant and they say like, hey, I noticed some gaps here, in the end, there's no substitute for an attorney when it comes to estate planning.
Okay, next question. I'm sorry, Laura, did you want to add to that?
No, he said it correctly. I mean, there is no substitute for an attorney, but and again, I think it's just going to be a collaboration, everyone being on the same page. That is the main important part of it. That's why you want to have everyone involved. So yes, to go to your attorney and based on what your wishes are and what you want to be done, then you could go ahead and address the tax part of it, because then we will know what your end goal is and how to address it properly.
Okay, next question. How does debt play into estate planning? For example, if someone owes $100,000 of student loan debt, but has a trust that states that $100,000 of any bank account goes to the oldest child and the paid off home goes to another child, can student loan creditors go after the heirs? So if there's any debt, whether it's student loans or any other consumer debt, can the creditors come after that?
Not necessarily. So that's more of like, when we're doing probate and everything. But if you have a trust and where you have beneficiaries listed, and some of the trusts depends on what your goal is, you could have a spend-through provision, what it's called, that if you leave the trust to, certain, like say for your son, and you can have it where that son cannot voluntarily or involuntarily, so, debt collectors come and take those assets. And it's part of drafting of the trust and what, the language that we use, but a creditor cannot just, dip into your trust account and just take everything away. So it's really based on the drafting of it, the language that we use and exactly what we want to be done. But to answer the short answer to that is no, but it depends really.
So as a follow-up to that, so what does happen to debt? So people die, they have debt, whether it's credit cards, student loans, a mortgage, right? So if they do not have a trust in place where that information can be spelled out, what happens to that person's debt?
Yeah, so it depends on the kind of debt it is. So different states have different laws. So where that, based on the kind of debt, again, that the creditors will still be notified that somebody has passed away and that there's an estate. And, based on where they fall, whether it is some debts are given more priorities than others. So it depends on where they fall. Some of the debts will be taken care of. And if they fall below, the last on the list, unfortunately, they just kind of like, sorry. But for the most part, based on the law and based on where they fall, as far as the kind of debt, they do get handled, part of the probate process.
So it sounds like, I guess, once they go through probate, all of that person's assets, whatever they do have, it will first be creditors, and then whatever's left over, then the heirs have rights to that. Is that correct?
Not necessarily. So it depends on how you have your estate plan, right? So if we have a trust, most of the time, if you do it properly, avoid probates, right? So if everything's in the name of the trust and everything is done properly, you don't have to go through the probate court. And of course, there are laws that, some creditors are still going to be paid, but that avoids the creditors being paid first and then your family being left with nothing. So if it is set up properly where you say, I want my family to have the home or this, they will get that house and they will get it properly. But if you are going through probate where we don't have a trust and, we have a will where it's a public thing, then that goes into, okay, the law will decide for you then how that goes. But really, if it is set properly, a trust that is set properly, avoid probates where your wishes will be done accordingly, according to how you set it out and what the trust language says.
Okay, awesome. So it sounds like the greater protection probably lies in a trust versus the will.
Yeah. And again, the will is a public thing. So when you do have a will, it does have to go to probate. So it is out there and it's a public record. Whereas a trust, your successor trustee or your co-trustee is the person that handles everything. So it stays out of the court. That person steps in, they say, okay, this is what their wishes were, and based on everything. And of course, the key thing is, right, we think of a trust, it has to be funded. We don't just, make a trust but we never put the house in the name of the trust. We never put the bank account in the name of the trust. Then that whole effort that you just did is wasted, because anything that's left in your name when you pass away has to go through probate. So there are different moving parts, but just have to make sure that it's done properly. So your end goal, that you didn't waste time, setting up this perfect trust, but nothing is the name of the trust. So then you do have to go to probate, and that whole process, can be cumbersome. But yes, if it is done properly and you have a trust and is funded properly, you can go ahead and avoid probate and make sure that your wishes are done properly.
Absolutely. And I'm glad you hit on that, because, I think some people miss that part of it. They'll go and they'll set up the trust, right? And that's the importance of having your team. So you would set up the trust for them, but then they should have their advisor, right? Or whoever's managing their accounts to say, hey, it's time to change your beneficiaries from an individual to the trust. So that's, the funding process is now going back and altering the beneficiaries for that. Great point there. Another question that came in, it says, does that also apply to medical expenses? So I'm assuming with the debt issue, if there are any leftover medical expenses from the person that was deceased.
So medical expenses, they're not the priorities as far as, who gets paid first. So most likely, your beneficiaries will still be able to go ahead and get how you establish it. So it's only a very few debts that get priority, right? That if you pass away and you have to go to probate, that they are going to get paid no matter what. And one of them being, attorney fees and things like that. But there are very few debts that get priority over what your wishes are, especially if you have a will.
Actually, I had a quick question for you when it comes to estate planning specifically for small business owners. Like, do you have any specific recommendations when it comes to like passing on your business or dealing with like protecting assets from liability and stuff like that if you're a small business owner?
Yeah, so part of a business owners, you could think of a business succession plan. So where you have it, I guess it's like the estate planning for a business, where you have a detailed plan of, okay, what happens if I do pass away or if I do become incapacitated? How am I going to sell the business? Do you have a partner, are you going to sell your shares to the partner? Or are you going to have someone, a family member or a third party, to go ahead and step in? So it's part of having a written plan to say the time frame, maybe in 10 years, you want to be able to step away and retire, or, in the event of your passing, to have a business succession plan to detail on what needs to be done and when it needs to be done and who's going to be able to handle that for you.
Thank you.
Thank you. You beat me to it, Hayden. We're going to talk about the succession plans as well, because I know, people have businesses and, once they pass away, the business goes with them in certain circumstances. Thank you so much. So I'm going to go back up. We actually had, are there any questions? If anyone has any other questions related to what we are talking about, again, do so, put them in the chat box or raise your hand if you'd like to verbalize that. But what I'd like to do, since we missed I believe 2 of them from last week, is I want to go back if either one of you would like to chime in on these questions. So the first one was, what is the best way to reduce fixed expenses? And that probably goes back to part 1 where we talked about cash flow planning. And then the second question is, why is it imperative in this day and age to own a home? So if anyone wants to chime in on that, we do have, I think, 2 of the other panelists from the previous session, so you can feel welcome to chime in as well.
So the first part, it was something about, I lost.
Reducing, what is the best way to reduce fixed expenses?
Fixed expenses. Well, I think there's no set in stone answer for that. I mean, when you think about, like, you have 2 kinds of expenses when you're in retirement or when you're even in saving for retirement. You've got your variable expenses. You can kind of choose and control somewhat how much those expenses will be, and then you've got like certain expenses like your mortgage. It is what it is. It's always going to be that, and it'll probably be that for 30 years. When it comes to how do you manage those, I think you kind of have to look at it and say, what are my priorities? Because like maybe a fixed expense you have today won't be a fixed expense in retirement. So for example, maybe when I retire, I've got a mortgage here, but maybe I don't live in this house when I actually retire. Maybe I sell this house and I downgrade. And then when I downgrade, I buy a house that I can actually pay for in cash. And so in that sense, I've managed my fixed expenses a little bit by planning ahead. Now you can also, pay down some of those debts like the mortgage over time. And probably one of the easiest ways to do that is to manage those variable expenses, reduce like how much you go out to eat and those kinds of expenses, use that extra money to help reduce the payments on some of those fixed costs. So I think there's a lot of opportunities there.
Awesome, thank you. And then the second question was, why is it imperative in this day and age to own a home? And actually, I'm going to add another question to that since it's talking about home ownership as it relates to estate planning. And this is does it make sense to add a child to the deed of a home? Let's say there's an older parent, they add the child to the deed of the home versus waiting to leave that home to that child after they pass away. So should they add the child to the deed of the home versus just gifting it in the will?
So I think the short answer on owning a home is it's not always what's best for everybody. I think everybody has individual situations. I know when I got my house, it's like there was a lot of repairs. There was a lot of expenses. And that's something you have to think about, especially when you get older in retirement. So generally, I believe home ownership is a great idea. It's a great way to build equity. I think overall, it is probably the best route for the majority of people. But then renting provides flexibility. It also provides the opportunity to not have to deal with the water heater exploding or finding out that the person who previously owned your house cut a hole in the wall and there's no load-bearing trusses in it. That actually happened to me. I actually had to fix an entire wall because somebody cut a hole in it and just put a door there. And so, that's the headaches of home ownership. So it's not always the best option, though I think it is generally better than not for most people.
Thank you. Leroy, would you be able to touch on as far as deeding over property while the person is still living, or should they just wait and leave it in their will or trust?
So it's kind of a depends question, right? It's kind of right. A depends answer that we've told in law school. That it depends, because if you're married and you we have in Florida, we have home state laws, right? So there's not really a need. It's like, what are you trying to do by doing so? Is it because you're trying to avoid probate? What is the underlying reason of why would you choose to put them on a deed now rather than wait when you pass away? So it's not a yes or no question. It's really, what are you trying to do with that? Because again, if you are married and you have a spouse and you have children and you don't have a will, even though the intestate law will take over to decide on how your assets are distributed, typically the homestead law will go ahead and keep that house to your spouse and your children. So I'm not sure if, I could say it's better to have it in a will or a deed, but I would like to ask, I don't know the person's here, but what is the the end goal of the why they would prefer, or they're trying to think of why they should do a will versus a deed, because there's more that goes into that to answer just yes or no.
Sure. So I think, and I'm just trying to read some of the background information here. So it's more so an older parent, should they pass away, so that way the adult child can go ahead and make decisions as it relates to the home versus waiting for the probate process. So I know sometimes that can be an extensive process.
Okay, so it's an adult child, not like okay.
Right, an adult child.
That makes more sense. So yeah, so you could go ahead. What we have different deeds, which is kind of like a life estate deed, where they can name the adult child as the on the deed, and them as the owner. They still can have all the powers and still be able to use have ownership of the property. So then in that case, yes, we can go ahead and name the adult child as the deed to avoid that whole probate process, because then it's a life estate deed, we call it, where the elderly parent still has ownership rights and still have control over the property. But when they pass away, that adult child, not a child, but that adult child can go ahead and be able to have the property and avoid that process.
Great, thank you so much.
Sorry, I misunderstood that there was like a child, like a minor.
I should have said adult child in the first place. Thank you.
Sorry.
Okay, so looks like, is it Geraldine? I saw you pop in. Would you like to add anything to the conversation? And for those of you that missed last week, Geraldine was one of our panelists to assist with the conversation. So any of those questions that you wanted to hit on?
Yeah, I just wanted to add on the house. You know, I completely agree. It really depends on the person's situation. I think one of the things too to consider just from a tax perspective is the step up in basis that will also happen on the property. So, you know, again, just another thing to weigh when it comes to actually transferring that property at death versus having it, you know, the person being owner of the property.
Can you give a short example of what that means, the step up in basis, and what that would look like?
Sure. So you would get, so back to the example that Hayden gave earlier, when it came to the step up on the stock, there is a step up on the basis on real property. So, you know, just something to take into account, because depending on how high value that property is, you expect it's not going to exceed the current limitations. However, you don't know what all of the property is involved in that estate. So that's why it's always good to have that team of people look at everything and look at all the factors. And of course, most importantly is, what do you want to do with it and what is your intention?
Thank you so much. So another question, and we're getting close to the end. We have about 7 minutes left. So any other questions, please type them in the chat box or raise your hand. We want to make sure that we get to all of them before we close out. So what are the most valuable questions that you can ask when looking for an estate planning attorney?
Most valuable question to ask to the estate planning attorney, or just to ask in general? Correct. Okay. I think with any kind of relationship, professional relationship, is really, can that person relate to you? Because, you know, at the end of the day, they're going to be personal. We're going to be all in your affairs, your personal and financial affairs. So really to have that comfort level and be able to trust that attorney knows the laws and how they're going to affect you in the long run. So whether it's asking them specific questions about your affairs, whether they understand the rules of the trust and the wills, just making sure that you're comfortable with that attorney, because they are going to be the one that are drafting those documents for you. And sometimes down the line, if it is an issue, it's too late. So it's really having the time to sit down and to take your time, not rush into it, but kind of like interview the attorney just as you would interview anyone else. You know, ask them their experience and, you know, how they see certain things and what their best advice would be. And just really take the time to decide on that, because you don't want it to be where it's too late because you've now passed away and the documents that were drafted incorrectly, or, you know, missed something and there's something we can do about it then.
Yeah, I think that's very important to take a look at, you know, how comfortable you are with them, and also what their specialties are, because I know estate planning can be it's a very extensive process. I know people that have special needs children, or special needs family members, and that has to be taken into consideration as well, as far as if that attorney has experience working with like special needs situations, and how that how that plays a part. So great question. Any other comments from our panelists?
Yeah, I was actually just going to touch on the special needs portion, if I could, just briefly. So I do have a special needs child. So one of the interesting things, and it's that while an attorney may say they have special needs experience, it's always good to, get references as well, or find out, try to interview various attorneys to get actually that expertise, because the first attorney, and again, I'm an attorney, right? And the first person I went to, they of course talked about their extensive experience, and it turned out that they actually didn't create the special needs trust that I needed them to. So I was able to see that. Someone who is not as specialized, it's just, do as much due diligence as you can, make sure you interview multiple people if you have something special that you need to take care of.
Thank you. All right, we have, we'll take the last question here. It says, once you set up the trust, does it stay with the same attorney, or can you go anywhere for changes or updates?
You go anywhere for changes or updates, but I guess the better question is, why would you want to go somewhere else? Because you want someone that already has the history of your finances and personal affairs, you want to make sure that they are still updating that and making sure that they are familiar with that. And of course, you're welcome to go to a different attorney, but then that's having that new attorney reviewing everything. And some attorneys will not update an existing trust. It's just for, their own preference as far as drafting, and just for some liability reasons as well, you want to make sure like someone will not update an existing trust and will want to establish a new trust. So it really depends on why you want to go ahead and go to somewhere else, and really what are you trying to do, and how extensive an update that you want to do with the trust or the legal document.
Awesome, completely agree. It's almost like changing your doctor every year. Going so you want to make sure you find someone that that you trust, that's reputable, that you've already established a relationship with them. So then I think they put in, if years pass by and the attorney no longer works, or for another reason. So that makes sense, right? If the attorney is no longer in the business, if there's not a partner that they have that you can go to. So of course, in those situations, I think it'll be a good to change. All right, so we are at 7:13. We will close out here. I'm going to allow for Hayden and Leroy to just provide final words, maybe one or two things that we could take with us as it relates to retirement planning and income planning and estate planning, just so that we can make sure that we keep that top of mind. And also, Leroy, I know that you're an estate planning attorney, so please do provide your contact information. We have people that may be on the call that may be looking, to speak with you or someone in your capacity. And that's also great that you have a background in financial services, right? Because that's also a plus, that you have that cross training, the financial side and then the estate planning side. So please do let us know how we can get in contact with you. So I'll start with Hayden, and then we can close out with Leroy.
Well, I think the moral of the story is that, start planning early, continue that planning process throughout every step of your life. And the more you do that, the more control you'll have over your outcomes. And there's been a lot of research on this. And what we find is that people who actively focus on their plan, they feel like, they're in more control, and they have better outcomes. So the more you are actively involved continually in the planning process, and don't just let it happen to you, you direct it, you're going to be happier with all your outcomes, and you're going to be feel more secure, and are likely to have a better retirement on top of it.
Great, thank you.
Yes, and I definitely agree with that, because the point of this whole series is to make sure that we have planning in place, right? And I think what 2020 and this year has reminded us that death is not reserved for the elderly or the sick. So we don't want it to be where it's something that when we need it, that we should we should have thought about it. So it's sometimes it might not be a comfortable conversation, but it's a conversation that needs to be had, even if it's a start to a conversation and we just do the small things that just making sure we have beneficiaries. Maybe you're not at the step where you want to sit down and have a full drafted will or a trust, but something as small as having a beneficiary in your accounts can save so much headache down the line. So it's just having a plan and starting somewhere. We don't have to start big, but starting somewhere with that plan.
Awesome. Well, thank you all so much again. So this concludes our 3-part Plan 65 financial series with Charles Schwab. And I have about 3 pages of notes from the last 3 weeks. So it was definitely enlightening. I hope that everyone that was on this call, and if you also had a chance to join us for the first 2 parts, I hope that you received information that you can take with you. And as always, if you have, please do contact Charles Schwab. They have a location if you're located in Central Florida, and they're international. So please do reach out to them for your financial services needs. And then also Laurora was able to put her contact information in the chat box. So please, if you have any questions for her as the estate planning attorney, please reach out to her. I'm sure she will be happy to assist with any questions that you have. So I'm going to wish everyone a good evening, a good rest of the week. And for all the mothers that are on the call tonight, definitely happy Mother's Day to you this upcoming Sunday. And I'm going to close out with a short video with Charles Schwab. But before I do that, if you are not following any of our social media pages, please feel welcome to follow our LinkedIn page, our Instagram page, and our Facebook page, in addition to our YouTube page, where this session will be uploaded with the first 2. So I'm going to show a short video and then we will conclude for this evening. Thank you all so much.
My mom taught me that whatever attracts you to another person is the way that person makes you feel about yourself. So to always be kind.
My mother taught me that it's never too late to say you're sorry.
Persevere when there's lots of hardships.
Courage to speak the truth.
How to be brave, courageous, and strong.
My mom's late to everything. I'm late to everything.
Empathy to understand the plight of others.
Smile and the strength and the courage.
And resilience to get back up no matter what life brought her way.
To weather any storm.
Most of the things that I do because I saw her do them.
So thank you, Mom, for showing me what love is.
Happy Mother's Day, Mom.
Happy Mother's Day.
Feliz Día de las Madres. Celebrate Mother's Day. Who's a mother? Mubarak.
Happy Mother's Day.
Say Happy Mother's Day.
Happy Mother's Day, Mom. I know I'm the favorite.